If you're building an investment property in Australia, there is a good chance you're leaving thousands of dollars in tax deductions on the table every single year. Because most investors do not know which part of their construction loan interest they can claim and when. As a tax accountant who has worked with 1500 plus property investors, I know this is one of the most misunderstood areas of investment property returns. And most investors don't find out until the ATO tells them. And by then, they have either overclaimed or now face big penalties or missed deductions they were entitled to all along. In this video, I will show you exactly which interest is deductible during the build, when you can start claiming it, and the one piece of document that protects you if you are ever audited. Here is what most investors don't realize. When you are building an investment property, interest on your construction loan starts accruing from the very first drawdown, not when the build finishes or the tenant moves in, from the first progress payment. That's a deduction most investors either don't know about or don't claim correctly. And on the typical build, it's worth tens of thousands of dollars over the construction period. But this is the bit you need to pay attention to. The rule only applies to the construction portion of the loan. If you have also borrowed to buy the land, the interest on that land component is treated differently. Since 2019, the ATO has applied a rule that denies holding cost deduction, including interest on a vacant land, if the land does not have a finished livable building on it that is available for rent. The interest sitting against that land isn't deductible yet. That means during the build, your loan is effectively split into two. The construction interest is deductible from the very first withdrawal. The land interest isn't deductible until the property is finished, occupiable, and advertised for rent. Most investors don't know that split exists. So let me show you exactly what it looks like in dollars. Say you buy a land for $350K and sign a construction contract for $450K. You take out a single $800,000 loan to cover both. Most investors treat that as one loan. The ATO does not. During construction, from the day the slab goes down to the day the occupancy certificate is issued, only the interest on the construction drawdowns is deductible. The interest on the $350K land component, not deductible, until the property is finished, legally occupiable, and advertised for rent. Here are the numbers. At 6% on $800,000, you are paying roughly $48,000 a year in interest. The construction portion, which is roughly $27,000, is deductible during the build. That's $27,000 in legitimate tax deductions that most investors either miss entirely or claim incorrectly by lumping them in with the land. The remaining $21,000 sitting against the land cannot be claimed as yearly deduction during the build, but the money isn't lost. It gets added to your cost base, meaning when you eventually sell, it reduces your capital gain. The key takeaways here: the construction interest is yours to claim from day one of the build, but it only holds if you can prove you always intend to rent the property out. And that intent question is where the next problem sits. If you're finding this useful, subscribe. I break down Australian tax strategies like this, and most of what I cover doesn't get explained until it's too late. So, a couple we worked with last year bought land in the southeast of Melbourne and started building a standard investor-specific property, 4 bedrooms, 2 bathrooms, double garage. 14 months in, one of them got a new job closer to that site. They moved in instead of renting it out. They had been correctly claiming the construction interest the entire time. But the moment they moved in, two things happened. First, the deduction stopped. The property was no longer held for the purpose of producing income. Second, and this is the part that cost them, the ATO carved out a build period as an investment intention window. When they eventually sold, they couldn't claim the main residence exemption. The portion of the ownership where the property was intended as an investment counted against them, even though no rent was ever collected. This is the cost of changing your mind. And it is exactly why the ATO doesn't take your word for it. They want evidence that you intended to rent from the moment you signed. So here is what the ATO will look at first: your loan application. Did you tell the bank it was for an investment or owner-occupied purposes? Are your building plans designed for investors, or are they highly personalized? Did you engage a property manager before completion? If it is held in trust, do you have minutes recording the investment decision? If none of that exists, you are relying on your word against the ATO's assessment. And that's not the position you want to be in. Now, everything I've covered so far assumes your build goes as per plan. But what happens when it does not? A client's builder went into liquidation halfway through the build. Construction stopped for 5 months. Interest continued to accrue on both the land and the construction drawdowns. The question became, is construction interest still deductible when nothing is being built? Yes, as long as you are actively pursuing the build. By finding a replacement builder and keeping the project moving, the connection between the interest and future rental income remains strong. Your construction interest deductions don't stop just because the builder does. But if that delay drags out for 12 months and more with no replacement in sight, the ATO can argue the connection has been served. At that point, the deduction is at risk. Now, here is a practical strategy most investors miss. If your loan has an offset account, keep your cash in the offset rather than draw down early. Interest is only charged on amount actually draw down. If the construction funds haven't been drawn down yet, there's no interest accruing on that portion, which means non-deductible land interest stays lower during the build and higher proportion of what you are paying is a deductible construction interest. It's a small decision at the start of the build, but over the 12 to 18 months, it compounds into real savings. Now, everything in this video assumes the ATO still see you as an investor, but there is a huge likelihood that they don't. Because if you have renovated a property and sold it, or you're planning to, there's a very real chance the ATO classifies your activity as a business. And when that happens, the 50% CGT discount disappears. Your full profit gets taxed as ordinary income, and you could be liable for GST on the entire sale price. I made a full video breaking down exactly how the ATO makes that call, the 3 buckets they use, the evidence that catches people, and one mechanism that could save you tens of thousands. Watch it here.